Hello friends, welcome to Nirmal. I am Piyush and today we are bringing to you a result review interaction. We are bringing to you Cigniti Technologies Limited, and today our guest for the show is Mr. Krishnan Venkatachary, the Chief Financial Officer of the company. Sir, welcome to the show.
Yeah, good afternoon, and thank you, gentlemen, and thanks for the opportunity. And good afternoon to all the listeners.
Thank you, sir. Now, sir, this result season actually also marks the end of the financial year 2023. From that perspective, and before we start talking about the headline numbers, overall, how has been this 2023? And I'm asking you this question from the perspective that we have seen a lot of events happening in the global markets, from Russia-Ukraine war to again sort of European sort of uncertainty, and then as we started moving into fourth quarter, it appeared that largely the global sort of negative news was slowly sort of settling down. So, what was 2020 looking like from the perspective of revenue drivers or client feedback to you, and how and where we ended on 2023 as per all the feedback?
Okay, yeah. So let me just take a step back and then give you the events which unfolded. If you look at, probably we have laid a strategy effective 2022 that where we are going to head in the next 5 years as to the planning. As per the planning, very clearly that we said that while the quote unquote the assurance businesses on the digital side, we thought that we will also couple the business with the digital engineering as 140. As anticipated, while we have built the capabilities on the digital engineering side, and the full-blown effect will be seen in the coming years, we did definitely make a significant progress in terms of the from a 5% revenue to about close to about 8-9% revenue, which we are able to get on the digital engineering side. But I think the more the strategy is that we were able to get through to our client and make them get excited very clearly that okay, we are part of the digital assurance and we can do the digital engineering, which we understand much better, and we'll be able to combine the value added services together to the existing clients, which is resonating very well. The second thing is that as anticipated, in the market, probably the clients have gone in for a cautious spending. Basically, the reason, to answer your question very clearly, that Ukraine war, which has affected predominantly some portion globally, but I think predominantly in the Europe. But our exposure to the Europe has been very, very, very minuscule, and especially only in the UK as a region where we have been holding. So that is not a cost which has affected it. But I think that has got psychological impact very clearly, and also the economic impact in the overall on the globe. And after that, when it came into the recession from the Europe, which is again the same answer basically, is that we have been very cautious and not investing dollars in the European region. The third portion is that the global economic events in terms of the US, and especially on the what do you call the BFSI as a sector very clearly, and especially on the banking side, which has created a dent across and things like that. And then the economic situation turning grim, and then people trying to move around the people and things like that. We have been cautiously watching, and our endeavor has always been that basically that if you look at even during COVID times, when you step back, we have not let go people during the COVID times, while we have optimized the cost by reducing salary by 5%. However, subsequently what we have done is that we have enhanced our efficiency in terms of trying to bring it to about close to 82% as the blended utilization. While bringing the utilization up, I think there are possible ways of utilization. One is that conversion into billing. The other one is that reducing on a regular basis in terms of the manpower which is not working effective or the performance issues. So that has been a continuous phenomenon. So basically, we were not really worried about the cost pile up and for us to do a massive cut or whatever it is. When it comes to the question of business, basically, we were focusing on our existing clients to really grapple and do the mining. And just to give you a breakup very clearly on 206 million of revenue, our targets works very well. Basically, that we did a new revenue which is equivalent to about close to 8%, which is a net new in terms of winning. And the rest of it very clearly about the mining was very high in terms of what we achieved comparing to the previous year to this year. So the mining portion creates stickiness within the client. So what we tried and worked out as a strategy considering the pandemic which hit us in 2020-21, where we started investing in the center of expertise, and then where we started making efforts into the digital foray, and we started getting into healthcare and retail in a bigger way. We felt that the strategy will work, and especially when clients are getting into cautious spending, we were able to grapple and clearly win over to say that yes, we are here to take smaller orders. In terms, basically, most of the orders were split between 2 to 3 million to say about 6 7 million, and not more than 18 months, and where clients want to take a look at in terms of their cost. So we filled that bucket, and especially for the existing clients. So this is how we have tackled. And while the situation was looking gloomy and getting better now, there has been
Right.
a deferment of spending by the clients in the, especially in the US region,
Okay.
considering the economic situation. But I think that is non-discretionary spending basically. And if you look at it, that is discretionary spending. The non-discretionary spending, which are very critical, which is essential, and which has to run through, are running. We are in that sweet spot basically. So I would say that we have not been largely affected. While 1 to 2% of our revenue definitely is getting affected with that, we are not largely affected.
Right, sir. And from that perspective, when I see that you have added almost 12 new clients during the fourth quarter, where are these clients largely coming from? Which sector? When I'm seeing that, and also are they largely coming from US and also from which particular sectors?
Yeah, 92% of my revenue is coming from US. So predominantly the addition is always in US, but I think in this quarter and partially in the last quarter, I think we have added a few marquee clients like Dubai airports in the Gulf region. We have added one of the leading auction house from the UK, which has been a kind of order win for 5 years deal, which we have signed in a tough market. And similarly, in the US, we have done few renewals of the on the BFSI sector on leading banks, which is almost 120% more than the current last year revenue. That is the kind of renewals which we have taken place. So, but if you look at the new revenues which is coming through invariably, we have got it from the healthcare sector predominantly. We have got it from the retail, and one or two clients from the travel sector. Yeah,
Right. So,
travel
I'm
clients. Yeah.
sure. I'm tempted to ask. There are two schools of thought here. One is basically the optimist would say that when the times become tough, the trend to outsource becomes stronger. So if retail is finding slightly slowdown, they'll try and find ways to really increase their digital implementations. That is number one, and that would hold true for any other sector also. And the second school of thought is when the time is tough, actually the entire spending plans they go for sort of postponement. So I just wanted for our viewers, I wanted to ask you, since you're getting orders from healthcare, from retail, and other sectors, are the clients really looking to sort of outsource more and more, adopt more digital transformation or digital assurance, more platforms, so that actually they remain sort of vigilant in the current times?
Yeah, I think it's a good question. If you look at healthcare as a sector, probably, yeah, one generally the spending, which is a focus for the client in terms of trying to run through on the digital side. We have seen a lot of encouragement and a lot of push in terms of coming through for the digital transformation. Two, if you look at the spending, basically, what there are two types basically where post COVID everybody wanted to get into the automation mode and every areas of automation which they wanted to. I think the those have been separated out, saying that very clearly that people said that we will get into the core engine which needs to survive and run their business, and rest of the outer periphery works have been deferred. Basically, they are trying to review it cautiously to get the best return. That is one of the reasons which is having a ripple effect in the major SIs, I would say, based on my reading. And the third portion, if you look at in terms of the healthcare or whatever I'm talking about, the unique phenomena what we have seen in the healthcare sector is that our expertise has always been working with the medtech devices, and there are a lot of push coming on the medtech devices getting released in the market. And because of our experience, we are winning orders and getting associated with the medtech devices company on this side. While on the retail side, the margin pushback is on the rate Discovery, probably there is a margin pushback, but I think retail is growing if you compare. And all these homegrown retails clearly are not cutting their spending. Spending is going, but they are using the economy, they are using the opportunity to optimize on the margin, which is fine with us because we have been also pitching in very clearly to come out and talk to clients saying that this is the time I can implement my automation tools to make it that your throughput is 20% efficient and then cost can be brought down by 15%. With a combination, we are trying to give in a what do you call double-edged sword, which we try to give to the clients. So when we see this as an observation, travel is one sector which you would say that the spending has commenced in a big way. The travel cost also has grown up manyfold, and now there is a binge travel which is happening around. So the sector where we have retained the people, we have crossed the COVID times in terms of the revenues, if you look at it, and we are optimistic that that sector for the next 2 years is going to continue to drive the growth clearly.
Fair to say, we have been hearing again across the result season about how strong the travel sector is performing. So, as you're just saying here, now coming back to the numbers here, let's talk about a couple of numbers. Staying on the course on number of clients addition, we actually saw 13 clients in first quarter, 9 in second, 13 in third quarter, 12 in the fourth quarter. Total 47 clients added during the financial year. Number of active clients, we are ending somewhere around 230 for the fourth quarter. We started with 235 at the first quarter. Help us understand on the trend on the number of active clients. Are there some clients which have just onboarded and they are going to become active, or there are also sort of some acquisition which is happening?
If you look through, basically, is that in terms of the number of active clients which we have produced out over there, during the year, basically, we did estimate a couple of clients which will ramp up, which were short-term contracts in terms of 6 months, which we picked up. It didn't ramp up, basically. That has been on the technology sector, which is understandable for us because we were trying to look at and work with them on the security and cyberspace, and then it didn't ramp up on account of their various other budgetary and other issues. Apart from that, in terms of the consolidation, probably what we are trying to look at is that we have devised a strategy about 18 months back, and then we've started implementing is that we are trying to make it clearly as what do you call strategic, nurture, and growth accounts, and bucketed the accounts under these three categories on a 6-quarter basis. And I compare on these accounts, basically, I think there has been a phenomenal growth, and that contributes basically for me. I think the top 70 accounts contribute probably close to about 80-85% of the revenue invariably. So my focus, or our focus, basically, if you look at our team itself 5 years down the line, where we wanted is that we wanted about top 30-40 clients to contribute about close to 65% of the revenue, and to create a lot of stickiness within the business which is available. And we want to bring down even this 240 clients further down, basically, so that our management time and bandwidth is given to clients which are more contributing, and where we can try to create a value add and be a partner on this space. That is one of the reasons we have even chosen the select SI play in terms of trying to get into this. Coming back to the what do you call the current year, except for the small acquisition which we did for that 2.8 million revenue deal of Round Square, which is helping us in accelerating the digital phenomena. I think all the accounts invariably leveraged out are very clearly organic in nature. And in the current year, yes, there is always a toying up with idea in terms of adding up value through inorganic growth, which is being tried out very clearly to add up some value proposition for the company in terms of trying to get some functionalities and specialities into the company. It could be a minuscule one, but I think there are a lot of proposals, and we are evaluating, and we will definitely disseminate uniformly as we get closer to it.
Sure. So you are looking at acquisitions?
Absolutely. We are not averse, and we have been very keen, and we have also laid it out in our strategy as well. That we will
Right. And this is particularly in any domain where you want to actually add any domain expertise, or in any particular geography, like what type of acquisition you're looking for?
We are trying to look at it something on the technology side, but I think I will leave that comment as of now, basically, because there's a lot of work going on and a lot of sensitivity involved. So I will leave that comment as it is.
Sure.
There's a lot of work
Noted.
going on in that area. Yeah.
Noted, sir. Point taken. Let's also talk about the sort of margin profile here. We have seen about 16% EBITDA margins, 11.6% about PAT margins. What's the outlook looking like as you step into the first quarter of this year and as you move ahead? How's the sort of
Yeah.
margin trend looking to you?
I would say that the marginalized EBITDA at about 15.5% for the quarter will be ideal because the differential 0.7% is or 0.5% is stemmed up from whatever has been what do you call the excess provisioning in few of the areas which is getting optimized out or whatever it is in a specific quarter. But I think if you look at the overall for the year has been at about 14.5% in terms of the margin comparing to what we were at about 10.2% or so. And even on a last year, neutralizing the one-off expenditures and bringing it at about close to 12.5%, I think we have improved by about 200 basis points for the whole year. Moving forward, what it looks very clearly is that we are very confident for the whole year next year. We should move up the value chain north of 16 at least. That's the target, and we are confident it will come. If you ask me specifically for Q1 to Q2, Q2 to Q3, how it really works and things like that, while we are optimistic, where we have gone on to cost optimization from our side as well, but I think there are also appraisals. While we have a limited number of people with 82% efficiency, I think we are trying to get through to some revisions of salaries, even on a nominal phase at about 9-10%. So we should be able to weather the storm in terms of trying to retain the best technology guys. So my margin should hover around that in terms of where we are at about 15.5 or so, I would say, on a neutralized basis, and then start moving up the value chain where for the whole year we should be up at about 16% plus.
Okay, so on an improved performance, largely we're taking the point home that these margins are sustainable, and we actually perhaps are looking at FY24 on a sustainable margin basis.
Absolutely, absolutely, we are very confident on that. Yeah.
Okay, and another point, sir, just to sort of compare quarter on quarter versus the December quarter, we actually are largely seeing a flattish revenue growth. Versus the last year, obviously there is a strong growth here, but versus the last quarter, there is a flattish growth. Is it largely because of short-term projects that would have helped the December quarter, or is there anything which you want to share?
There are two things which I would like to share. Because there were some discounts which we are negotiating as a volume discount for the annual basis, which we didn't provide in the books to the tune of about $400,000, is one thing. And these were basically with the change in vendor management office, what was assured and promised. Probably we had to conservative basis. We thought that let us provide that. Basically, that is one thing. The second thing is that there were in December we had certain short-term projects. When it comes to Jain, Feb, March, we had an unplanned reduction also coming through to the tune, which was affecting us to the tune of about close to about $800,000, which overall spanned up at about 1.2 million, which we would have been there at about close to, while we are there at about 52.1 or 2 million, we should be there at about close to 53.5 million or so. So these are the two reasons. But I think we are back on track in terms of the subsequent quarter, and looks bright basically because with the order book position, which I would say that currently where we are, I'm estimating based on 85% on a confirmed order book and plus the routine renewals which are running through, even at about 85% of the renewals put together, we are there approximately at about close to 202 million of order book position. I've scaled down the renewals from 95 to 85. Keeping the market in mind, so 202 million. I think we are sitting on a pretty tight wicket, absolutely comfortable, and with a lot of other progress happening around probably. I don't see a issue in terms of the growth coming through for the next year. But I think just specific to the quarter, definitely, yes, we have done these two, which has hit us on reduction in the revenue.
I wanted to close our conversation on the revenue growth trend in FY24, and you just started actually giving numbers. So if I actually match up the numbers here, $200 million order book would roughly translate to 600 crores plus minus 2-3% here and there. We are talking about an sort of annualized numbers of revenue as for the fourth quarter, roughly around 1,700 CR. So this is your existing revenue growth, and then you have an order book. Usually, sir, when you say an order book, is it something where you are already sort of in talks, or it is already on a conversion stage? I'm not trying to sort of link revenue growth trend here.
No, no. Let me be very frank. I think in the last 2 years, average revenue growth on dollar terms, if you look at it, where we have done it about close to 20 plus odd percentage, 22%, as said. I think we are targeting for the next year also. While though we don't give any guidance, I think we are confident the way the run rate are running very clearly that we should be there at about the same growth. But when it comes to the question of order book, when I talk about order book very clearly, I talk about order book which has been signed very clearly as a signed SOW, which is there with me. Second one is that a signed MSA under which these are annual renewals, and these renewals are the relationship over a period of 4 years, 5 years, and 6 years term, and which are bound to happen regularly at about 100%. But I have considered for my purposes at about 85%, considering various things in the market. So it's always good to go with an estimate and then push the sales team out to say that with a 22% growth or 20% growth average, what we need to try to do are about 25% growth. What could be the delta which needs to be really pushed out? And for that delta, we analyze our funnel in terms of the pipeline as to at what probability stage of closing at about 95%, 90%, 85%, 70%, and which bucket to move up and things like that. That's how we start working. So we are very clear in terms of the working and the numbers.
So which implies that we actually can look forward in FY24 at 20-25% dollar growth like that. That should be something which should satisfy you.
I mean, the run rates today and the kind of targets what we have internally and the kind of the order flow which is coming through, I mean, we are very optimistic that though we don't give any guidance, I think we are very optimistic that to repeat the current year performance on the
Well,
top line.
I think that should please our viewers. I think for our viewers, I think the message is basically the margins are sustainable, the revenue growth momentum is looking intact, market is still kind enough again for your sales team. Broadly, again, basically the clients are looking robust. So I think those all points I think should be really pleasing for our viewers. Sir, thanks a lot. It's always a pleasure to have you on our show, and we look forward again towards engaging with you again towards the next results or maybe even before. But for now, it's a huge thanks from our side.
Yeah, thank you for having me, and wishing the best to everyone. Thank you.
And to our dear viewers, thanks a lot for watching this show. Hope you enjoyed it.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from Nirmal Bang.